Hello, everybody. Welcome to another installment of the Build Weekly Roundup. Today, you've got just Matt and myself. We'll see, if we have Dave back in the future. I think for now, we're gonna have him focus on a few other things, free up some more time. There's a short heads here on our side, so we're trying to make sure we all get the best use out of our time. But I'm excited for
We're
this
we're gonna
week.
put Dave on a weekly webinar to start selling the metal. I know for all the tens of people around the world who were very thankful to join and listen to us each week discuss our color commentary on the key things to watch in the macro landscape. We're gonna focus Dave on actually selling the metal. So we don't shill too hard on this podcast, but we're gonna focus Dave on another content project, specifically on education, branding, etc., on our firm's capabilities and offerings.
Yeah, and what that means
So
for
watch out
all of
for that
them is
coming.
they get to see more of you, more of Dave, and hopefully some good content coming out of our team here. So I'm excited for that. Um, in terms of this week, there's been a lot of hoopla over the recent non-farm payrolls release. We're going to definitely dive into that. Matt will also go through some of his kind of findings or some of his framework and views around the Circle IPO, which is very big in the stablecoin space. And then in the Bitcoin arena, a few interesting movements there that I know we want to both touch on. So I'm excited to just dive into this week's episode. This week we titled it "JPM Bends the Knee to Bitcoin." I think it kind of telegraphs where we're going to go with this. But to start us off, let's start off with macro, and to just jump straight into it, the non-farm payrolls. So Matt, go ahead and take it away here. You have this nice chart of the non-farm payrolls release with some interesting colors. So maybe explain to our viewers here what these mean, what you're seeing, and kind of this trend over time.
Yep. So we focus on the headline number for the monthly non-farm payrolls report, but we also think it's important to look just a little bit deeper as well into where the jobs are reportedly coming from. So following trend, the employment picture has been kind of steady in the United States, according to the BLS's monthly non-farm payrolls report. This was what we just got this morning, June 6th, 2025, as we're recording here, was the May data print. And it's just important to caveat, we'll talk and compare and contrast in a second with the ADP report. ADP is a payroll processing company servicing, they've been around for 30, 40, 50 years, and they service kind of legacy established, I'd say medium to the largest of the large private sector businesses in the US economy. The BLS is really trying to get a number for the holistic economy, in its entirety. What does job growth look like? Granted, the ADP is also trying to give you that number for the private sector as well, but their differences in methodology, their survey, et cetera, leads to some slightly different conclusions. So we'll get into that. But just to start, what you see is, all right, we had what would be called a good print today. This morning came in actual number, and granted, this is a model, right? They're not actual jobs, but 139,000 job growth is what the BLS sees in the U.S. economy for the month of May, versus what the forecasters saw, 126,000. So that response on the beat came in as a like kind of a positive, I would say, on the markets, and it led to this phenomenon we'll talk about in a second about dollar up, interest rates up, and then risk assets up, kind of aligned with the trend we've seen for the last 18 to 24 months. Um, but if you notice here on the color coding on the different like sectors or like components of the economy where the job growth actually takes place, it's very obvious, just eyeballing this, two things of importance. Number one, the green shaded region. Apologies to those in the audience who suffer from color blindness or similar issues. But there's a section in green that's like the largest bar every month going back multiple years now in the NFP data, and that is for education and health services. So this kind of aligns with, both of these sectors of the economy, by the way, are largely government involved and supported. So education, from the grounds up of like preschool to, post-secondary, et cetera. And then healthcare services, we know this, phenomena with the U.S. demographics, as well as, just following the trend of, developed markets and the G7 countries more broadly, with, the age of the population increasing, which requires more, nursing, healthcare specialists, et cetera, to take care of these people. So that green chunk has been, the steadiest contributor to jobs in the U.S. And, while education, if you have kids, you have to educate them, right? If you don't, it's not going to be a very good picture economically, starting, 15 to 20 years down the road, that'll show up. So you don't want to cut education. You don't want to pull back that payroll, so long as you have that front end of your demographic curve. But then as the late end, as the boomers continue to retire and age and require more services, that healthcare service is looking like a steady, consistent component of jobs. Now, what's disappeared, and this is very clear since the new administration took office, there's a segment in blue that's basically the top of each bar, in this chart going back to 2022. That's government, right? So it could be state and local government, but also federal, right? And so what's the most, one of the most jarring and controversial initiatives from the executive branch, maybe you say tariffs, but also the DOGE initiatives, which involved federal government job cuts, we call them furloughs, et cetera, voluntary retirements. So that the government sector jobs, as you see, like since the March payroll number has been nil, right? Actually, going back to February, it's at the top. You'd be circling something that's not there anymore these last 4 months. So the government is not expanding its employment base, which is going to be a continued headwind for job creation, which basically means private sector is going to be looked to pick up essentially the majority, if not the entirety, of the employment slack. Comments there, Cameron?
Yeah, I was gonna say something that's interesting to me as I look through this is that despite kind of seeing that decline in government payrolls, it doesn't seem like there's a massive negative government bar, right? So on August 2022, if you look at that one, that's the easiest one to just see. You've got this huge bar over here, but you really don't see any big negative of the government colors until here, and even then, it doesn't come close to what you see in previous months. So I'm just kind of calling that out just to say,
It's
there's all these Doge initiatives, things like that, but I haven't, we're not seeing it yet in the data, if I understand this correctly.
This is the nature of bureaucracies. We've known this for, since the buildup of the large European states, right, for, multiple centuries now. It's very hard to trim the bureaucracy, right? So what Doge actually did is they had to get, they offered, um, what would you call it? Like a voluntary separation program, all of that. And most of those, people who accepted that early retirement offer, they're actually not even going to hit until September. So point is, yeah, a negative, that like an actual contraction on the blue bar. Yeah, you can see them on the negatives. We should have put a line in here because the Bloomberg graphic doesn't separate out the cutoff from positive to negative on sectors very clearly. But yeah, that the blue line may turn into a negative as you start seeing the roll-offs from those Doge voluntary separation agreements starting to trickle in September.
So if I kind of project forward a little bit in terms of consumer spending, we've been talking in multiple episodes now about when it comes to some of our growth numbers, things like that, it really hinges upon the consumer. So what I'm seeing then is I'm not seeing any major negatives in terms of payrolls. I'm not seeing major layoffs, things like that. So I would probably expect some stability then in terms of consumer spending kind of rolling forward.
We need yeah, we need the jobs to keep this budget situation humming along. So, and granted, it's also important to caveat that the map is not the territory here. Like this isn't a survey accounting of every job, audited, et cetera. It's a modeled number based on a lot of data inputs from the BLS process. But it's one of those things like it's an imperfect speedometer.
Right. And so then contrast this for me. You called out the ADP numbers. These look very different from the BLS numbers, or I shouldn't say really different, but in terms of the overall change in the last month, it seems like these are showing a little bit less of an increase. So maybe you can explain how these are calculated and why they're different.
Yep. So this is private sector as well. A report that comes out a couple days ahead of the NFPs every month, but it's published by ADP, which is a itself a private sector payroll processing company. They do a little bit more than that in terms of like HR, data management, those type of services. But they have a good look. They're the market leader in terms of mid all the way up to the largest of the large cap businesses. Basically, just processing, wages, payroll, income, retirement savings, all of the above. So they have a fairly good view of the economy, I would say, the employment picture from how middle market corporates and above are doing. And what you've seen in this report for the last two prints, April and May, is quite a bit different than what you see from what the NFP report has showed the last few months, which is it's the purple line in this chart, which has actually been, if you look, it's kind of like an uptrend since roughly January, beginning of the year. Now, granted, we know the NFP report, it is model based. It does have some issues catching up with inflection points or significant turns in the data. And these are things you only know in terms of revisions to the NFP report, like months or potentially even years down the road. One of the factoids coming out of today's release was actually the jobs growth that got counted for prior to prints, March and April, were revised down by a total of 95,000 jobs. So just kind of take this all with a grain of salt. It's like, well, what they showed you in March and April initially, cut those by 95. Today's beat, in comparison, it was 139K, I think the print was, yeah, versus, where ADP was at 37K. These may kind of calibrate out and get or just close the gap against each other as we record more months and the BLS revises its figures. But what you do notice for the ADP print this month was goods producing actually contracting in the US. So you talk, if you listen to us kind of week after week, you get our framework. What do the tariffs represent? Well, when you turn the tariffs on, your what you're effectively doing is slowing down the consumption of, the US economy, firms, households, individuals, et cetera, of consumption of goods, right? That come in on shipping containers from all over the world into US ports. And when you're the business or consumer comparing goods, apples to apples, one product versus the other, you don't necessarily pick it up and look at the back and say, where was this manufactured? What the number one variable you're going to look at there is price, right? What the tariffs do is they shift the playing field towards the domestic producer because they've added an extra cost for imported goods. So this print in May from ADP that goods producing jobs actually shrunk is an interesting what would you call it, like counter trend evidence that maybe this remains to be seen. We're going to need to see more data, but maybe the U.S. consumer or um, you know, business, households, et cetera, their consumption of like physical goods, off of store shelves or just purchasing from, manufacturers, et cetera, maybe this thing isn't humming along, to the degree that you'd want it to. So it remains to be seen kind of what's the state of the healthiness of the U.S. domestic consumption. But I think that's a key thing to watch if you're following this story and markets brought progression throughout the remainder of the summer and into half two of 2025. But key tell here what the goods producing jobs contraction for the first time since July, August of 2023. It's a very interesting data point we just got this Wednesday on the ADP employment report.
I think it's also interesting to call out, that there's been a lot of people talking over the last few months now, since tariffs were even announced, that this is going to impact the U.S. hyper negatively. We're going to go into recession immediately, things like that. And there's kind of that period where it's the is ought piece, right? The tariffs ought to do all these things to the economy, but they really weren't up until more recently, right? So we'll see whether or not, like you're calling out, that this actually turns into something we need to be worried about. But is it also just a revision that needs to happen to some of these prints, right? I mean, it
Yep.
just this gap here seems very interesting to me that it's so far
It
off.
it will close. It has to one way or the other over time. Well, if you track these cumulatively as well, so that would be an interesting print. It's like, one survey reports jobs growth in the US of X, the other reports Y, and they're, over the course of several decades, they're nowhere near each other. And that just tells you what's the quality of this actual data, which brings in,
We talk
deeper
about paper
questions
gold, paper Bitcoin. I
unto
mean,
itself.
paper
Yeah, paper
jobs.
jobs.
It'll be interesting to
um,
see.
yeah, but if you're the US Treasury or even, a large player in the US financial system, one of the big five banks, et cetera, the last thing you want to see right now is the US to actually tip into nominal recession. You do not want to see job growth down, um, or, credit issues, et cetera. So, I mean, it would just make the whole fiscal situation worse. So that's what you don't want to see if you're a policymaker or key figure, reporting into something like the Treasury Borrowing Advisory Committee. So that's what these people are watching.
Well, and so then speaking of kind of markets, how does this translate into what you're seeing in the treasury market itself? So I'm going to pull the slide up here. You call out rates up, dollar up, risk up. You walk us through kind of these technical analysis lines that you're seeing, that you're charting out on this chart here.
Yep. Um, okay, so we talked about rates up, dollar up, risk up. So when we see the U.S. economy not going into recession, things running hot, everything moving along. Just because of the underlying fiscal dynamic, the debt situation, we have to keep this and the debt to GDP where it is, in excess of 100%, 120%. Um, when people have jobs, that means spending continues, which means borrowing, continues, credit expansion, keeps going up and to the right, all that stuff. Um, and we've heard Besson say this now. The operating plan, as of the last 2 to 3 weeks, is we're just nominal GDP needs to grow faster than the debt itself, right? And so what that ultimately implies is, all right, if so long as we can keep the economy growing nominally above the rate of the treasuries, right, or above the rate of the debt, treasury interest rate, or above the rate of the debt, ultimately, like, so long as the economy doesn't budge, right, just keeps coming along, treasuries need to march up to that, right? And that's effectively kind of what you're saying, to put it in oversimplified terms, but that's what's going on. So rates up also pulls the dollar up. We saw on the NFP report today, because it was good in the view of capital markets and the street. Um, Interest rates up, pulled up the dollar as well. So we have the dollar up against every major currency here. I'm looking at the currency matrix. If we did a screen share here, you could see it. But dollar is green versus, everything. Swedish kroner, uh, Norwegian kroner, Hong Kong dollar, New Zealand dollar, Aussie dollar, Canadian dollar, Swiss franc, British pound, the Japanese yen, and the euro. Just full sweep up on the NFP reports day. So it's rates up, dollar up day. Equity markets are up 114 bips. The Nasdaq, the Qs are up, and Bitcoin, while it's crossed over into a retrace off of that very sharp move it had from 74K up to a new all-time high above
Yeah.
$111,000. It's still up today, right? So it responds to that same kind of underlying dynamic. Rates up, dollar up, risk up, back on trend. So where the treasury is now, you like to see my long duration chart. Where this looks like to me, because we broke out of that uptrend channel, right now we're still navigating along, but we're at the bottom now again of what that channel would be. So the pressure is we're tilting not towards a rates rally, but rates want to go higher. Is where on balance it seems to me like they would want to move. No, that's price up, which would be rates down. We we may see some improvement of rates. Someone remember August of last year when you get an NFP print that scares the markets, you may see a rally into treasuries, rates come in, et cetera. But right now, the balance of the market looks like it wants to see rates, march up to where the U.S. Economy's growth rate is, or nominal GDP. So if you look now, instead of that upward sloping channel, maybe I can get the direction
This
right here that we were in. The blue, that's gone, right? We broke it. Since we broke below it, it tells us that more than likely, like the bears took some ground, and balance of power, they have the upper hand right now in the tug of war. Rates, watch for rates wanting to move higher. It may not be, on a day-to-day basis or week-to-week basis, but over the next months, quarters, et cetera, I would be watching for that orange. You call that like a pennant or a wedge. Since those two lines aren't parallel and slope together, they're converging to some point, is what it looks like now. Where things get interesting, in my opinion, is once we get to that black dash line. If and when we see this, that's the new line I would watch for. A meaningfully sized and like aggressive move as the tug of war effectively is one, and the other side fully lets go of the rope. Where that would be, well, you see that little last time we ticked that black dotted or dashed line, that was at about 5%, 5.05% for the 30-year. It's technically upward sloping now. So that critical level where if the bears see it and they take it and they break through it again, that yield where that happens now is actually going to be lower, right? It's not 5.05 anymore. It's 5, possibly. So if we break it again, that's where the long end of U.S. Treasuries risk, a larger move, in my opinion, to the upside, and that would be, in my framework, a capitulation by the long end of the bond market, conceding on this entire kind of framework, this setup that we discussed, where, okay, Scott Bessent, we agree, you're going to get it. You're going to run nominal GDP high, and there's nothing we can do about it. So, we need higher rates. So that's what we're watching for. That's where I would draw the key levels right now, as a trader or fixed income allocator for the long end of the yield curve. Now, Any questions there?
I would say so. Something that's interesting to me is that you still have Trump pressuring Powell to cut rates, right? And so that seems almost antithetical to kind of what you're seeing in the market itself. So, maybe can you explain the why is there pressure from the Trump administration to push Powell to actually cut rates when when Bessent has already said, we're kind of giving up in terms of trying to roll the debt over. We're going to just say, look, we're not hot. Why still
Yep.
pressure Powell to do that?
Yeah. So what we're talking about here, this chart is the long end, right? So it's the right side of your treasury yield curve. It's also the least by far amount of capital out there, right? So it tells you what the treasury would have to pay to a kind of a free and open market on the long end, right? They're still doing a lot of financing there with the SOMA account. So it's not entirely true, but this is what insurance companies, pensions, et cetera, would charge on the long end. The front end is what Donald Trump is pressuring Jerome Powell in on the questions, on a day-to-day basis, where we see all the headlines, like every article, whatever happened in the markets today. Yahoo Finance is going to say this was because of what investors think the Fed's going to do next. It's like that's not actually
The
uh,
soundbite trying to get
how
you
this
to,
works, but it's
yeah,
a very easy and like non-refutable, core position or thesis. But what Trump is pushing for on the front end would be like Fed funds or overnight rates for the most, liquid and marginal source of dollar capital into the overall financial system, which is also anchored to where more and more of the maturity of the debt is, as we get more and more front loaded, right? So that it's also it's actually not the highest cost of debt anymore. Like
I think like the 2 to 3 or something
Fed
is
funds at 4 to 4.25. No, 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 no. 2 to 3 is the lowest.
lowest. Sorry, yeah.
Which just broke above 4% today on the NFP print. So that square root sign or the check mark sign on the curve, like the low point of the curve is like that 2 to 3 year. Um, but what Donald Trump is pressuring for is the front end cuts, which would really hit money markets, SOFR, et cetera.
And those are in the 4% range
Would
right now.
everything variable rate, tied to SOFR or that financing would get cheaper, right? So real estate loans, a lot of mid-market credit, like anybody who can't do fixed rate borrowing, right? So those lower rates will make it easier in the US economy for like the riskiest sectors to finance themselves, roll over old debt, um, without belt tightening on some real estate projects, let's say, that took out financing in 2020, 2021, et cetera. Or it just could be, yeah, the new small business, middle market business, those size, or that kind of component of the US economy getting capital financing. Like it makes project financing, employment growth, all of that easier for the riskiest borrowers in the economy, which is like, if you're the president, you're like, well, I want to see more jobs growth. I want to
I would say
see
to tie it back to the very
nominal
beginning.
GDP
Yeah.
up, cut, and also it helps the treasury, right? All of the financing and bills, and the front end, a cut of 100 bips might lower your interest expense by 20%. So you're in line to try to pressure the Fed. Now, if you're the Fed and you do that, what you're effectively doing is you're putting more pressure on the net interest margin of banks, right? Because most of them would be dependent on that interest income coming from where the money market rates are, anchoring to. And it actually makes things harder for your banking system, the US commercial banking system, which is who the Fed represents, right? It is their business franchise. So you've got this juxtaposition. Someone's going to have to, um, budge here. Ultimately, the Fed does show in their economic projections they do see cuts, but right now, if you cut, certain things happen, which, like last September when they finally started cutting, what happened? They lost the long end. So you're at a point where you're between the rock and the hard place. if you're the Fed. And ultimately, like the how the economy progresses is going to, inform them what they need to do. I would still bias, like market still shows 2 year is below the front end, so there's still cuts on the horizon on the short term. It's just a matter of when they can actually be implemented. So where is that window? And then on top of that, and then this leads us to our next segment, right? Well, if the Fed's not going to cut and we need a new buyer of treasuries,
Where does the demand come from?
where are we going to park them? And this comes into what's going on with the Genius Act, um, and the this week's hot IPO, the Circle IPO. So for those of you just new to this development, Circle is a business that was initially a partnership, kind of one to one. But it's a stablecoin operator for the USD coin, which crypto ticker USDC. Um, it's at this point it's got a consortium of liquidity providers. Largest among them probably Coinbase, but they did just you know add Binance in December of 2024. So all of the crypto exchanges have really adopted at this, or the majority of the crypto exchanges have adopted this USDC, which is a U.S. domiciled stable coin, in contrast to the market leader in the stablecoin space. At this moment, about a decade in, Tether, which to date is it operates offshore. Um, just for perspective, Tether is about 154 billion in stablecoin issuance outstanding. Um, USDC is about, I want to say 64 billion is what I saw recently, I think is the figure. So Tether is about 2.5x the size of its next closest competitor, which would be USDC. So USDC just IPO'd this week. If you think about, if you're a venture capitalist and you're looking, hey, when do I want my company to IPO? You want to do it at the best possible price, right? Where you feel like you have the tailwinds at your back, all those things, market conditions are set up. And this week, you would say the Circle IPO was very hot, oversubscribed. I want to say like 25x for the placement. So it came in at a 25 billion valuation, which if you look at, I pulled here on Bloomberg a list of, equity screen for financials, or sorry, banks and payment focused companies. So consumer finance, commercial finance, et cetera. And I think the key thing here I wanted to get across, I think my image might be blocking part of this. I don't know if you can take me off the screen so everybody can see, Cameron. But yeah, so 25 billion would put Circle in the territory of like what come in as the like top 15 to 20-ish ballpark of the largest US bank holding companies. So some of the names on those lists, you see First Citizens Bank shares, Huntington Bank, Fifth Third Bank, right above it, M&T Bank, in that general area, as well as some key, just players in the banking and payments industry, which is where Circle is competing, offering an entirely new model. I'll get into that in a second, the next slide, but it just shows you, already this Circle thing, and with Genius Act coming, there will be other stable coins set up. What the market is already showing is, hey, commercial banks, watch out. Like this, technology paradigm is here. You're going to have to adopt to disruptive change. So I think from my perspective, you look at industry dynamics, like creative destruction, all of that. I would be most concerned if I'm just a pure play regional commercial in the US, just focused on deposit banking, and extracting the majority of your income out of just credit. net interest income, that approach. I think what this Circle IPO is telling you is like, it's been 10 years right now, like 15, technically 16 since Bitcoin launched. But Tether's been around since I want to say 2013, 2014, and growing. This is really your wake up call, in my opinion, to the U.S. Commercial banking system. And another point on that, we talked about Tether being the actual market leader here, and it's pretty broadly known at this point. Tether is very public about, and they, become more and more transparent about their reserves as well as their income statement for their endeavor. It's a very small number of employees. I want to say like, 10 to 20 on staff to operate what is effectively, if you took this valuation of Circle at 25 bill, multiply it by, 2.5, you're starting to get into like a 60 to 70 billion dollar number. And if you look at the firms in that range, so you've got US Bank Corp, PNC, you've got PayPal in there, a non-bank competitor to the US commercial banking system, who has been who the banks have been worried about ever since the 2000s when PayPal arrived on the scene. You're looking at like US Bank as the fifth largest bank holding company in the United States. So like these guys, like what this is saying is stable coins really matter. And if you're a commercial bank or, incumbent in this system, my opinion, this is, probably the last warning sign you're going to get to start developing strategic initiatives around what's going on. You could say with crypto, in my opinion, it's a Bitcoin story, and that's where you should focus. But regardless, like this is a time of, I would say, disruptive challenge, innovation. The barbarians are through the gate, right? At this point, you really have no choice if you're on an executive committee, or if you're in charge of biz dev or strategy at, one of these names. I mean, and this list goes, very long. There's a long tail here, but if you're not developing on this new technology, paradigm or platform, your market cap is at risk.
Yeah, and I think something else to call out here too is just that there's been a lot of talk, articles coming out of some of these banks claiming that they're going to get together, make their own, issue their own stablecoin with a consortium of each other, but none of it is actual movement, right? USDC, Tether are out in market today. Tether has, you can actually get Tether at an ATM in some foreign countries. USDC, same deal. They're actually out to market. They're gaining consumers. They're gaining customers. But you're just not seeing the movement or the, I guess, the urgency from the U.S. banks. Some of that absolutely has to do with regulation. I wonder if, with the Genius Act and all of that coming out, they're just kind of waiting to see what that looks like. But even then, if you've got the franchise name already out there, people understand what you do, how you do it, then rolling out a, Tether US version is going to be a much easier task than trying to spin that up from scratch and convince people to move off of Tether or off of USDC onto your USD regulated coin that's
Yeah.
sponsored by these banks.
I'll try to make this as simple as I can and straightforward, for hopefully there's someone in the banking, financial services, or payments industry. If you're watching, let me put this very straightforward. So there's something on this list in this space that is a competitor that's not present, and it's Bitcoin, right? It would be number one, 2 trillion market cap. So if you're trying to, wrap your head around what's going on, what is the paradigm, what do I need to adopt, what is the disruptive technology, this idea that it's going to be some new blockchain, some crypto, some Solana, et cetera. The market is already giving you the signal that technology to build around is this thing that's 3x bigger than JP Morgan at this point in time already, which is, the game theory works. It's join or die, right? So it's opt in voluntarily. But if you choose to build on that thing, you get all of the superpowers that Bitcoin offers. So this idea that, hey, I need to, I'm bank number 50 plus 51. And if I do that, we can lock in our market share. Be careful. Like the way it actually works out, if you build on Bitcoin, you're anchoring to the biggest thing, and everything that anchors to that is going to be pulled up this list, right? So a lot of strategy involved, a lot of complexity, but at the end of the day, it's very simple. The core choice here, it's hard to see what's not discussed, right? Or what's not, grabbing headlines. But what's really going on here, zoom out. This is a Bitcoin story. Anchor your business to Bitcoin. It's the largest thing. It's the thing that's not talked about. But if you pull into that momentum, that gravity will, be the thing that uh, allows you to outgrow your competitors and cost efficiencies, all of that.
Great. Well, so let's dive a little bit deeper because for our third topic, we're going to want to go into some of these Bitcoin pieces that we've alluded to. I think let's focus in on Circle really quick. Maybe dive a little bit deeper into kind of what's going on here with some of these commercial bank deposits. I'm going to flip over to the slide here. You put
Okay.
the slide together. I'm curious. We've talked earlier in the show about how if front end rates come in, that kind of puts some pressure on commercial banks, right?
Yep.
They make money off those net interest payments. Circle conceptually to me seems like a similar revenue stream concept. So maybe explain what you're
Yeah.
seeing here.
So what we didn't put in this slide is a discussion of the Genius Act, right? Which is in the US Senate right now. It's reached cloture. So um, the bill we get or would be ultimately signed into law should look something like what we see now. There will be amendments added, that type of stuff. But what we know now already through, the bill's progress through the Senate is, the US regulated stable coins, what they're going to look like is just going to be pretty, we call it just generic from stablecoin to stablecoin. They'll have to, by law, hold reserves, 1 to 1 in U.S. Treasury debt maturing within 93 days. So no one can compete on reserves. Like Tether's reserves are a blend of treasuries, gold, Bitcoin. They've got multiple things in there. They're not fully reserved on T-bills. The US regulated and domiciled stablecoins, they're all going to look the same. It's T-bills, right? And granted, you can have different, every week there's a new T-bill auction, times six, right? Or, seven, like there's a lot of different maturities, a lot of different Q-sips, but by and large, they're all just stuff with the same thing. Front end maturing US Treasury debt. 1 to 1. And so these tokens that will now exist are fully reserved, I guess, bearer assets. They're non-interest bearing, right? And then they'll trade on, technically it doesn't specify, but just blockchains, public or private, right? So what the consumer is actually getting here as a dollar kind of token asset is a totally different model than the way we think of as dollars in this, credit banking, credit depository banking configuration, where your deposit is actually a super senior on-demand claim against the assets of the commercial bank, right? And so if you think about those two things, right, what is actually like your dollar that you bank, like for your banking counterparty, what is it actually? It's a full liability, right? It's reserved against I guess you have the assets, the cash, et cetera. But then you're also insured because of the fractional reserve nature, deposit savings versus readily available cash and vault, if you will, at the bank. That system requires things like the FDIC, right? Which will potentially bail out depositors in the situation where banks run into insolvency issues. So highlight that because if you think about these stable coins as 100% reserved in T-bills, which are very close to money-like, right? They're interest bearing, but incredibly liquid, low duration. You could say zero credit risk. because we'll always just expand and print more bills if the system needs to. Barring a debt limit shutdown that doesn't get resolved right in the short term. And we've still never encountered one of those, despite running into the situations countless times at this point. And you just assume it'll always, operate similar to that, where, all right, if you did get into a situation with the debt ceiling, it'll all be resolved, and you'll print more, um, bail out the old bill holders with new bill issuance, rinse and repeat. Um, but the stable coins would be reserved one to one. You wouldn't need an FDIC technically, and all of these extra added costs to the system of running the credit and deposits based commercial banking model that we're all used to, like for the last, I mean, forever, essentially hundreds of years. Um, and so I wanted to call out what you see in the Fed's H.8 report, the backing of on large commercial bank balance sheets of treasuries, treasury securities, and then cash reserves. These are, you could say printed Federal Reserve notes held in vault, or it could be the bank's reserves that they hold on deposit with their regional Fed branch, right? But if you add those two things up, those are like a similar comparison to the reserve requirements, if you will, of a stable coin under the Genius Act of essentially full dollar reserves, right? So what you see is, all right, ever since 2008, you see a positive trend up in both treasury holdings per dollar deposit, as well as those cash reserves um, per dollar deposit. They're going up and to the right over the course of the post 2008 environment, which to me is kind of the bank's way of showing that they've been trying, like, the model has been trying to migrate that to what Genius Act is ultimately representing. And you'd say cryptocurrency and blockchain technologies enable, but in my opinion, it's all Bitcoin that really matters here. But that trend is very clearly up and to the right. You see higher highs and higher lows on this chart. The lows occur, what I would say are like at the bottom of the dollar credit cycle, as reserves become depleted. Yeah, and it's super apparent in the cash if you look at the green, which is it's summing the two, right? And then the highs I would say they take place at the top of the what would be viewed as the economic expansions. Um, and so overall, you see, that trend is moving up and to the right. The banking deposit, or the credit-based commercial banking model is what this is showing is it wants to migrate to this new paradigm, that fully reserved, stablecoin banking or banknotes on these new rails that Bitcoin enables, and represents. So, you see things with an IPO of a new venture taking place, immediately moving into like the large players in the U.S. Banking and kind of payments industry. I think that's a key development in this technological transition that the banking system is going through.
I think it's a really interesting point. I didn't even understand that until you just pointed that out. That if we're looking at this as of today, it's about 50 cents to $1, like you're calling out here. It's almost like the Genius Act is it's a trade off. It's saying you have to go to one, but in return, you don't actually have to provide yield back to your customers, right? If people
Oh,
start to move on to the stablecoin rails.
oh, you don't have to. It's a bridge that's optional to cross. But if you look at like growth rates and trends are what matter, right? If you're a boardroom executive or C-suite, um, you got to get on trend. So if you look at stablecoin issuance, Tether supply. growing at about 30 to 40% year on year, pretty consistently. Had a big impulse on the 2020 big print, but since that big Python eating the pig, type of thing with the 2021, 2022, everything that went there. Things settle in. The last 2 to 3 years, Tether's been growing at about 30 to 40% in its issuance supply versus if you look at other deposits in the Fed H.8 report, it's like 2.5, 3%. So what this is telling you is the growth is actually in this new paradigm. This is a trend that could take, multiple years, potentially decades to develop. But you also get into that, go back and read Clayton Christensen. Once the time comes for the innovators to disrupt, the legacy players, and they'll do it because they have a better cost structure, and then they have growth behind them. Those trends will run into each other, right? So if you're just, what you don't want to be is the horse, saddle, and buggy whip salesman when Henry Ford is already just IPOing for, Ford Motor Company and just cranking out Model Ts, by the thousands.
Right.
That's what you don't want to be.
And speaking of kind of legacy players and trying to move on to the trend, I think, this was other big news for us, again, as Bitcoin enthusiasts ourselves, we're seeing this as a big step change, right? I forget exactly when he said this, but for a while now, JP Morgan has been of the opinion that they're anti-Bitcoin, right? And so Jamie Dimon, forget again which interview, I'm blanking on it, but I remember him saying, they could change the code whenever.
It was Davos, like
Davos.
2023 or
And
2024. Yeah.
now they're here, right? So you've got we titled our episode "JP Morgan bends the knee to Bitcoin." I'm really curious, maybe Matt, can you explain what the news is first off for our viewers, and then kind of go into your analysis of it, moving out from there.
Yeah, so the announcement. So first, like this is kind of a series that's been coming out since about May 19th or 20th. When JP Morgan announced a policy change, they were going to allow their clients to buy Bitcoin, right? And maybe they even couched it and said cryptos, right? But all right, buy Bitcoin is the is the key thing. So they're going to open it up. They're going to service Bitcoin holdings for their clients, as a capital market solutions provider. So that announcement on May 19th or May 20th was like, all right, we're not going to resist anymore. Open the door. Um, and then this week, it was, Monday or Tuesday, I think, they made the announcement. Not just were they going to let their clients, or help their clients buy and hold Bitcoin, they were also going to allow the clients to borrow against, what they list as crypto ETFs, but in terms of market cap, right? It's all Bitcoin, right? You haven't seen the same degree of market cap adoption on the ETFs and the, other cryptos, launching products as the spot Bitcoin ETFs themselves, right? So the BlackRock, Bitcoin ETF is in excess of about like $70 billion in market cap. And when you make the announcement, we're going to offer crypto financing against our clients' ETF holdings. What you're actually saying is Bitcoin, right? Bitcoin is dominant against the altcoins, the stable coins, or the four-letter word that more accurately describes everything that's not Bitcoin. This is a story of an acceptance of Bitcoin as collateral for JP Morgan's financing. All right. So we have a bit on rates, right? Because everything now is like rates matter. How do you lower the cost of capital on rates? Does JPM getting into this game change change the game, right? And ultimately, everybody wants lower rates on Bitcoin backed or Bitcoin collateralized lending. How do you do that? You get more players entering the game, competing, and with their own lower costs of capital, that will ultimately drive, that convergence and spreads down on Bitcoin or on dollar lending into Bitcoin. And so just to illustrate here, JPM, this is their fee schedule for their wealth management arm. JPM is like a fully diversified financial services company, global. If there's anything in finance and there can be money made at it, you can guarantee two things: they're going to be involved, and Goldman Sachs will be involved. Everybody else has kind of maybe a little bit more limited resource, but they're going to be in it if they can make money doing so. So this is the wealth management arm of JP Morgan, their broker dealer kind of division, which is different than the investment bank, different than the commercial bank, all of that. Um, this is their borrowing rates for self-directed clients. Like what that means, self-directed, is you're not hiring JP Morgan's wealth manager or financial advisor to make the investments for you. You choose. Um, I think it's TBD. I didn't get in that May 19th or 20th announcement if they were going to include Bitcoin in their own in-house model portfolios that they automatically invest clients in. So not for sure if it's a kind of a direct exposure for their own model portfolios, but for self-directed clients, you're free to go in and buy the Bitcoin ETF shares inside of your brokerage account. You know, some of these large broker dealers, they may require you to, just sign a special form saying like, I acknowledge the risk of Bitcoin or cryptocurrency investing, et cetera. But at this point, they're going to let you do it. And so if you look at this fee schedule and you just go down all of the fees, trading, et cetera, you get to margin lending. And what they look at is you've got a rate card, if you will, for what's your borrowing rate going to be for a specific loan size. And so if you sort down to the list where you're looking at scale, right, that's what matters. And so they publish, they base on first the prime rate up to $3 million. The prime rate is just kind of a financial industry rate. It's not like I don't even know who publishes this benchmark, but you can go find this. It's right now it's 7.5%. It'll be published in Wall Street Journal, et cetera. So if you add that prime rate, which is essentially what the large banks or a commercial bank would charge its best clients, 7.5% plus 2.5 spread, you're going to get a 10% rate of borrowing on a loan against your Bitcoin ETF holdings up to $3 million. Now, where things get interesting is where you get some scale. And what JPM is willing to lend to you if you want to borrow for in size of 10 million or above, they'll lend to you at SOFR plus 185, right? Which at today's rates is it nets to 6.14%. So if you're looking at a cost of financing and you want to do Bitcoin back lending, you can go through and look at bonds for say Cantor Fitzgerald or its kind of sister entity broker dealer BGC. It's less. Their front end bonds are trading at less than 6.14. But if you were to get into the Bitcoin back lending game and you had collateral you wanted to hold and you wanted to borrow from a top of the top tier counterparty in JP Morgan, right? Because you're borrowing, where you custody your assets is only as good as your counterparty, right? And ultimately, there's no counterparty that's as good as the Bitcoin protocol itself would be the core proposition of the Bitcoin thesis. Well, in the capital markets world, it's hard to beat JP Morgan here. So what they've actually opened up here by the Bitcoin ETF lending is, that basically the highest quality counterparty you can get, in the perception of the capital markets. You can borrow from them against your Bitcoin holdings at 6.14%. So this is, a pretty meaningful development in the Bitcoin and US dollar kind of interaction that we're trying to catalog week by week for you on the weekly roundup.
Yeah, and as fund managers ourselves, we're definitely in this space. So staying on top of these developments is super critical for us. I think we within Build have our own opinions on kind of how custody should work or can be done better, or different types of custody models that work best for safeguarding that collateral. But when it comes to if you're a borrower, if you have ETFs, if you have IBIT, for example, this is absolutely an option for you. This is just further proof that Bitcoin is being adopted by all of these TradFi legacy players. So I'm excited for it as a Bitcoiner myself.
Game on.
Game on, exactly.
Yeah.
And so let's move forward here. So just to kind of tie this back, Matt, you made this point about JP Morgan exiting in 2016 from the repo settlement market. So I'm curious, can you tie that together for me? I was not in the financial services space in 2016, so I don't have that background that you do on what was
Yep.
going on there.
Yep. So we talk about the repo market, right? Overnight financing. And it is like critically important to the functioning of the dollar credit system, right? It's a marginal source of dollars and liquidity in the context of the system. And there's different like kind of sections of the repo market. So what JP Morgan kind of made a big announcement in the 2016, 2017 kind of time frame was their withdrawal from servicing as a like settlement provider for the GCF, general collateral facility, like repo borrowing, where you basically have government securities, so treasuries posted with your intermediary um, for repo borrowing. JP Morgan announced it was exiting, like it was pulling out of that business in 2016. It had about a 15% market share. The other 85% was BNY, um, Bank of New York. So now all of that business is essentially flowing into BNY. They're the only firm servicing. So why would JPM pull out? I think at the end of the day, it comes down to like market, P&L, profitability. They were not making enough money here providing this service. So if they can't make money doing it, they're going to stop. Full stop. And so pulling out of the GCF market, which is, we talk about SOFR, right? Um, and the big change that's taken place since, really since COVID, probably the biggest change in the global dollar credit system since bottom of last cycle with COVID, undoubtedly been the transition from LIBOR to SOFR. But what this is showing, even with that, the center of gravity moving away from the city of London towards New York and the dollar credit system. JPM, the numbers just didn't pencil out on the income statement, so they pulled out of that market. So I think, if you're just looking for milestones or signposts along the way in this journey that we've been on since 2008, to see this week's news where where JP Morgan has really transitioned from public comments that were hostile to Bitcoin as recently as, it probably could have, they were definitely heavy in 2023, citing that Davos interview with Jamie Dimon on CNBC that Cameron mentioned. You could probably still find them in 2024, where they were not willing to jump on the Bitcoin train. This is, in my opinion, like a key signpost on the overall progression of this story, and the highest quality U.S. Counterparty in the game getting into the Bitcoin space and signaling that it's too big of a market now, too big of a business opportunity to ignore. That's a huge development for where Bitcoin is in its own journey.
Yeah, exciting times for us. I think we're as Bitcoiners again, we're very hopeful to see where this is all moving. So this is another milestone, like Matt said. Well, thanks for listening to this week's episode of the Build Weekly Roundup. Hopefully, you tune in for our next episode. You can find us on X, YouTube, and LinkedIn at Build Markets. Feel free to drop us comments. Our YouTube videos, are available for comments, so we'd love to hear feedback, all of that. Also, for myself, I selfishly want to see what people are most interested in hearing from us as well, and I could try to tee up questions for Matt based off of those comments. So, thanks again for tuning in, and see you all next week.